afternoon, ladies and gentlemen. The Reserve Bank of India unveiled its credit policy stance for the forthcoming 6 months early morning today. While nothing much was changed, everything was held constant, including the interest rate values. Let's understand the policy a little bit better. You'll see a lot of data coming into the graphics format, but to discuss this and a lot more, we are now joined by Mr. Aditya Pagaria, Senior Fixed Income Fund Manager at Axis Mutual Fund. Namaste to you, Aditya, and a very warm welcome. How do you look at the scenario of interest rates being held steady by the Reserve Bank of India? Do you think we have ended the interest cutting cycle as far as the economy is concerned?
Pleasure to speak to you, sir. Yes, the RBI has maintained the policy rate. They have not changed anything. But you need to look at the rate cuts that RBI has done in this cycle. It's close to 125 basis points. Plus, there have been, multiple liquidity measures that RBI has taken for past 1.5 years. Just to give you some numbers, RBI has given lots of OMOs, lots of FX intervention swaps, plus lot of repos also. To put together all these numbers add to almost 17 lakh crores of liquidity measures that RBI taken on top of 125 basis of rate cuts. So obviously the economy demanded these from a central banker, and the central banker has delivered it very properly. Our house view has been for last couple of months that the rate, we are actually nearing the end of rate cut cycle. We might have a long pause by RBI before we see it moving to the other direction. So it's a pause from our side for maybe next year or so.
Okay. The stance for the MPC is neutral, Aditya ji. And at this point of time, we are also blessed with inflation, which is below the official threshold limit for the Reserve Bank of India. How do you see growth against this background? And are we slightly, mildly accommodative at this point of time? How should you see the transmission taking place?
Obviously, the stance is neutral, but what liquidity measures that RBI is taking, and the RBI is very, hearsay to the market, whatever the market needs in terms of liquidity, in kinds of support, in terms of OMOs, the RBI has been very accommodative in that scenario. But looking at growth perspective, what we have seen in last 6 months or so, once that tariff issue started, the growth has taken a bit of a hit, but obviously good thing is that this RBI MPC is very, very neutral, balanced between the growth and the inflation both. So inflation has helped by, as you said correctly, 4 to 6 was the band that RBI has had in mind as far as inflation is concerned, but we are close to 2.5% for the entire year. Meanwhile, the growth has taken a hit, and RBI has given equal importance to the growth. That growth should not get tampered because of various external reasons. So for this reason, RBI has been doing what the market needs and delivering very consistently on to ensure that growth has not dampened.
Okay, I'm just seeing the US, the Indian 10-year yield, Aditya ji. This is your benchmark. The low was hit on June 2025 when it was at 6.15%. From then on, the yield has hardened to what it is today, 6.72. Against the backdrop, we've also had rate cuts. Now, how do you see the 10-year yield from now on? And what do you think are the two reasons behind why yields are hardening despite the kind of effort that the RBI has done to keep borrowing costs lower?
Very relevant question at this juncture, actually. So many people or investors have asked us what are the probable reasons that, in spite of a 125 basis rate cut, we have seen 10-year move up by 50 basis points. So obviously, just to give a very a nascent for the nascent investor. So what happens is the market actually tries to take forward guidance from the RBI. So they have already discounted that we would be seeing almost 100 basis 125 basis points of rate cut 1.5 years back, and actually before the RBI actually started cutting rate. So on the flip side, actually, if you see, before the rate cut cycle started, the 10-year bonds were close to 720, 725. With the rate cuts happening, the bond yields, as you correctly mentioned, it went up to 6.15, 6.25%. But obviously, the joker in the pack was when in June policy, they actually changed the stance from accommodative to neutral. So market actually panicked that time, and obviously they thought that actually we are at the end of the rate cycle, that because the RBI has changed the stance. The another reason was a demand supply mismatch. So in terms of the supply of G-Sec and SDLs put together. So that was we did some internal calculations and work. So total gross supply for this financial year for G-Sec was close to 14 and a half lakh crores, plus SDLs would be closer to close to 11 lakh crores. So if you actually find the supply and you track the demand for it, we saw a gap of close to 3.5 4 lakh crores of excess supply over the demand for this G-Sec and SDL put together. So that was one of the reasons again that market has sold off a bit. Now the market is balanced. Now we assume that RBI won't be cutting rate or hiking rates too soon. It will be a a flat kind of market for next 1 year or so, and we expect the 10-year G-Sec to be range bound between 6.75 to 7% for next 6 months or so.
Okay, now two questions come to my mind immediately. These are practically oriented. As a senior fixed income fund manager, Aditya, how are you retailoring your portfolio given the new realities? Below par inflation, growth coming ahead, possibly a pause in interest rate cuts now, and possibly the end of the cycle, and more importantly, fairly decent demand for credit in the economy. Right. How is your portfolio going to change?
So we have actually changed almost, you would say, 70-80% of the portfolio what we used to run, say, a year back when the RBI was in rate cutting mode. Our portfolio used to be more of the duration of the portfolios used to be at the higher end of the curve, as permitted by SEBI according to fund guidelines. It was more of G-Sec oriented portfolio, obviously, to take benefit of the falling interest rate scenario. Now, if you see, our portfolios have changed a lot. We have cut duration across our funds. You take short-term funds, you take gilt funds, dynamic bond funds. We have cut the duration across. Our portfolio are more attuned to corporate bonds, 1-year CDs, AA assets, to ensure that with a stable kind of a rate scenario for next 1 year or so, let's move the portfolio from G-Sec oriented portfolio to corporate bond oriented portfolio, which are actually available at a very attractive spreads over the overnight rate. So just to give you numbers again, with 5 quarter as an operating rate and liquidity being on a easy mode, 1-year CDs and corporate corporate bonds are still available roughly around 200 basis above the operating rate. So 7 quarter band 1 to 3 year corporate bonds. We believe that the investors will definitely be happy rather than taking a volatility oriented call by being too heavy on the G-Sec curve at this point in time. So from a mark-to-market oriented funds that we were running in past for 1 year ago, now our portfolio is more of accrual oriented.
Right. Now, a large percentage of senior citizens are actually fixed income holders. For those who have invested in bond portfolios via mutual funds, what would you suggest they do? Look at which kind of tenure. Do they need to maybe sell the long term and look for the shorter term bond performers? What do you suggest they do?
Again said, it is for senior citizens as well as any individual investors who don't have time to track the markets, time to time the markets on when to enter, when to exit. We have a couple of funds in our portfolio where, we internally tell them as a flexi cap of equity fund. So investors need not time the market on which curve to be in, whether to be in duration, when to be in accrual. Plus, if they remove or switch the money in between, obviously there are tax implications based on their income bracket. So we have a few funds like Income Plus ARB Opportunities Fund. So it is a portfolio where we run 35 to 50% of arbitrage positions, and the rest positions are run as debt portfolio. So debt portfolio, we have the flexibility as a fund manager to take duration calls, to be in gilt, to be in corporate bond, to be in credit oriented strategies, money market strategies. So it's a best of all the worlds for the investors, without them actually timing the market and without them actually studying the state of the economy, tracking the bond markets, and tracking what things are happening globally. They can leave their money with the fund managers who will take the best of the call to ensure that their returns are protected in case of any kinds of market that are there in debt markets. So in that sense, it is better to be in these kind of portfolios where we have the full flexibility from going from duration to accrual, corporate bond to G-Sec without any tax implication for the investors.
Okay, fair point. Let's look at the shorter term tenure, and with this surplus liquidity and so many OMOs, how do you see the money market? How do you see short term yields?
So as I told you that we have seen a spike in 1 year yields, 1, 2 year, 3 year bond yields for in last 1 month or so. We have seen almost a 50 basis kind of sell off. It's typically happens in a Jan Feb March portfolio, in a Jan Feb March of any year. Typically the banks obviously look to grow their balance sheets. The credit requirement for the overall economy is higher in this quarter. And obviously, if you track credit deposit ratio and incremental credit deposit in the industry, it is quite high. Almost 81% of the money is being lent, deposit garnered are given for credit. So that is the reason we have seen a short-term spike in 1 year to 2 year bucket. We believe Jan Feb March actually is a very good time for investors to invest in mutual funds, fixed income schemes, because we have typically seen April, May, June is typically a very lean quarter wherein the rates actually come down from a spread of, as I told you, 100, 200 basis above operating rate. We might see a better the spread compression overall as compared to a repo rate in April, May, June. So this is something that any retail investor should look at investing in fixed income schemes in 1 to 2 year kind of bucket oriented schemes, wherein we expect the spread compression over repo in next 6 months or so.
Okay. Aditya, how would you characterize the banking system at this point of time? The RBI seems to be blessed with enough forex reserves. There is good credit growth. Rates have come down. NPA, GNPA cycle is drifting downwards, and of course, there is deposits could be better, but they are what they are. So, if you were to surmise the entire banking system, many of stocks are doing extremely well in the market as well. What kind of a feeling do you get at this point of time?
So actually, if you see, the banking system as a whole is actually at a peak of its health. I mean, where we have seen a large amount of gross NPAs and NPAs in closer to COVID years now, because of the central bank, as well as it is working in tandem with the finance ministry. Both have put together, given all kinds of relaxations in terms of risk weightages, in terms of liquidity requirements to the banks and the overall economy as a whole. That has led to improved credit quality, better flow of money from banking sector to the industrial sector, and that has helped the overall economy as a whole. So I mean, it is rare actually where the government as well as the central bank are working in tandem together. We have seen these kind of high rate cuts, liquidity infusions, plus measures from the finance ministry like GST cuts when we were having a problem with the tariff and everything. So in that bad times, both the powers have come together, supported the market, and that is the reason we are seeing a very healthy banking system overall in the country. And obviously, we believe that with these kind of measures that are actually very rare. I mean, for example, we have seen these kind of measures in taper tantrum way back in 2013, then during COVID crisis. Again, we have seen such kind of, these two entities working together for the overall benefit of the industry. So that is actually a good sign, and no major mishaps have been there in the economy, and that has supported the banking system as a whole.
Right. So banking is healthy. My final question to you is the fate of the rupee. Since the yields started to harden, we've moved from 83.5 all the way up to almost kissing 92 versus the dollar. Now, given that two major trade deals are out of our way, the RBI policy is also now easing, the budget is okayish. What do you think the fate of the rupee will be over the next 3 months?
As you pointed out correctly, actually that there was an uncertainty related to the trade deals. India has done a fantastic job in signing trade deals with the EU and the US. Both obviously the fine print and everything is under process. But whatever the pressures that FPIs and FIs were having in terms of uncertainties regarding trade deals, our growth trajectory, what will be the growth trajectory going forward, that has taken now care of by signing of these two trade deals. And obviously because of that, as you said, from 92 we have below 91 as we speak now. So the excessive pressure that was on the rupee has been taken off now. We hopefully now see with growth outlook becoming more better because of trade signing off with two major economies, and obviously we are in in work with other economies to sign similar kind of trade deals, obviously the growth will be taken care of and stability will be there in the equity markets as well as fixed income markets. So next 3 months also we don't see any major worry on the rupee. Obviously, the rupee would be more aligned with what other economic currencies are doing as compared to dollars. We don't see any major knee-jerk, rally in rupee or a major sell-off in rupee next 3-4 months.
Okay, Aditya ji, what a pleasure speaking to you. Thank you for your understanding of the money market as also long-term bond yields. We'll close it here. Thank you for your time.
Thank you, sir.
This, ladies and gentlemen, was a discussion focused on entirely the bond markets after RBI's credit policy, in which the MPC kept the repo rate unchanged at 5.25% with a neutral stance and judged growth to be strong and inflation to be benign, but continues to watch the build-up in external and geopolitical risks. Thank you for watching. Have a nice day, and we shall now be meeting on Monday.
Hello and welcome to Business Today. I'm Siddharth Zarabi and we are coming to you from the World Government Summit in Dubai. As part of our conversations with a lot of people from different sectors, I have now with me the CEO of AFP, Fabrice Fries. Welcome to the show. Thank you very much for your time with us today. Earlier today, I was